I'm going to give you guys a little background in case you're not familiar with our panelists. Kirsten is the managing director of Forerunner Ventures, which is an early-stage e-commerce, consumer-focused VC firm. They're behind a number of the category's hottest brands and biggest exits of late, including Dollar Shave Club, Jet, and Bonobos. And she was named VC of the Year by TechCrunch. Next to Kirsten is Anton Levy, the managing director at General Atlantic, where he's done mid to late stage deals for some names you might have heard of, including Alibaba, Uber, BuzzFeed, Vox, Airbnb, Snap, Facebook, Squarespace. A lot of well-known names there. And David Trujillo on the end is a partner at TPG, heads up the private equity giant's tech investing, where he's written some pretty big checks for companies including Spotify, Airbnb, Vice, Cirque du Soleil. And he recently joined the board of a little-known company called Uber. So we're going to talk about Uber. We're going to talk about trends. But I want to start by just talking about the market. Investors have been predicting dead unicorns for 2 years now. And we've had some big failures, but nothing like the carnage that's been predicted. So was Bill Gurley just wrong, or was he early? David, why don't we start with you?
You know, frankly, I've been surprised by it as well. I thought we were more at a tipping point going back about a year, 18 months ago. And I think you're right. I mean, while there have been names that come up, and more recently things like Jawbone and some others, I think it's been slower to come. I think there's, some reasons for that. One, companies raised a lot of capital. So private companies, I mean, they have given themselves the ability to pivot many times, just given the cash they have on the balance sheet. I think another thing that, we'll see how this plays out over time, but it's different than 99, 2000, where a lot of that carnage took place in the public markets. It was very clear where value had dropped to because you had a market price. And you had much more independent boards at the time.
Yeah.
Whereas now it's happening in the private market, somewhat less independent boards, many founder-controlled companies, many VC firms that gave founders or management the vote on their shares. And so you don't quite have the dynamics to allow things, even when things aren't working, to return capital to shareholders.
So what we're seeing is a lot of zombie companies.
Yeah.
So I want to share a data point. There was a recent story that said that 294 companies raised rounds of 50 million or more in 2015. And of those, 216 of them are still private and haven't raised more funding. So Anton, I'd be curious from you, are those companies knocking on your door? Are they more humble with their valuations and terms?
I'd say the following, which is there are a lot of those companies we keep an active dialogue with, so we're talking to a lot of the companies.
Are you waiting for their valuations to come down before you put money in?
Look, valuations are still inflated. It's interesting. A lot of people, this is a conversation that comes up a lot, which is valuations are high, and they are. This is a good time as an entrepreneur if you have a good business, ideally a great business, but a good or a great business, it's a great time to raise capital and valuations.
What about the ones with not so great businesses?
I think it's more challenging, but the point I was going to make is that valuations have been elevated for a long time. If you look actually at certain data and you look at since, and we had done some work on this recently, since 2013, about mid-2013, you've seen valuations stay reasonably elevated.
So is this the new
since
normal?
that. I think it's been the case for years. I don't think it is the new normal. I don't think in the next 5 years you're going to have the same elevated environment without any correction. I think you're late in the cycle. I think recession is usually what brings valuations down. I think right now, if you look at most data, the economies in most parts of the world seem to be reasonably strong. But it's hard to predict what's going to change that. And when you have a recession, which you will in the next number of years, I don't know if that's going to be in 1 year or 3 years from now, but you will see valuations.
What are you modeling now, 1 or 3?
We don't try and model, to be honest with you. What we do is any new investment we're making, our time horizons are typically minimum 5 to 7 years when we look at a new investment. And so we model a recession in all of our new investments that we're making. We don't know if it's going to be in 3 years, 1 year, or 5 years. But in the next 7 years, for sure, there's going to be contraction and a recession. And so we try and model what that looks like. We won't sell when that happens. We'll try and ride that through. But we're assuming in any new investment that anyone makes now, I think it's foolhardy not to assume you're going to.
So one more question on the late stage: is there still too much late stage money? There was, in 2015 there was this big influx of Fidelity mutual funds. Everyone was backing the unicorns, and they kind of retreated. And the sovereign wealth funds have come in and taken their place. Is that keeping valuations afloat?
again, these guys should weigh in as well. I mean, I tell you, there's tons of capital. It's not just that, is there still capital? Actually, if anything, there's more capital than there's ever been. And it's coming from not just the mutual funds and some sovereigns, lots of private equity funds, traditional buyout funds are raising.
For example, TPG.
TPG is one they've been around for years doing
Yesterday,
it.
Egon Durbin of Silver Lake said that they're putting a lot more of their efforts into doing deals like the one they did with SoFi.
And I think you're seeing a lot of that. So you're seeing that, that there's a bunch of other firms that you'd be familiar with that are in the process, some that's public, some that's not, that are raising growth funds. You see a lot of family offices doing growth investing. So it's coming from not just the sovereigns, it's coming from lots of different places. And I think people have seen there's been great returns for a number of years. I think, my guess is that if you fast forward through the next cycle, a lot of those newer entrants, just because they're coming in late in the market, valuations are going to adjust in a recession, that they won't make it through, multiple cycles.
So,
a
Kirsten,
number of these firms.
Kirsten, you had an interesting theory about this, that because of this, VC is becoming less of a hits-based business, and that a lot of funds, especially on the early stage side like yours, are more interested in $500 million hits or $200 million exits. Can you talk more about that?
Well, I think it's one theory, right?
Okay.
I mean, in 5 years ago or so, when I was launching Forerunner in earnest, getting ready to raise our first institutional fund, I was trying to talk to everybody who would talk to me and tell me a little bit about what contributed to their firm or their fund's success. And I heard a total mixed bag, but I heard a lot of, this has been a very hits-driven business, and it's been driven by big cycle opportunities. And the opportunity for companies to go public readily, and the opportunities for play into big markets and create new businesses. I think we're at a place now where there is we talked about the supply of money. I would talk about the supply of deals. Entrepreneurship is hot. People really are interested in kind of being part of that ecosystem, whether you're just getting into business that way or whether you've been in an existing company and now you're thinking about making a transition in your career. So there's a lot of talent coming to the ecosystem. A lot of companies are starting. It's not terribly hard to start a company and get it going. And at the same time, there is consolidation happening at the bigger end of the market. The big companies keep getting bigger. You can
Which
look
makes it more difficult to exit, right?
It makes it more difficult to exit.
There's only a handful of
It makes it more
companies that
difficult to
could buy-
exit. And so there's a couple implications about that. One, I think as an investor, you have to be, that much more educated and that much more disciplined about how you're investing and what markets you're investing into and what the landscape is in that, and thinking about, the relevance of the business that you're contemplating investing in and how it might play out over time, and et cetera. And the other one is to think about, how can you get those investments to work for you in success stories of less than $1 billion. I mean, the reality of having, every company every firm in the Valley have multiple companies in their portfolios exiting of north of $1 billion is kind of I think it's a daunting challenge to put on ourselves.
I mean, Anton, one thing that you're doing in order to find new targets is going international. Can you talk about how that's going?
Yeah, listen, I think, there's been a ton of innovation that's happened in the United States for 30, 40, 50 plus years. Our view, and my view, going back a number of years from now, is that you'll continue to see tons of innovation in the United States, and that'll continue. But you're also going to see tons of innovation and growth around the world.
A lot of investors have been burnt trying to pour a lot of money into India, especially.
And I think, like markets, US included, I think people need to be careful and do their work and diligence and the like. But I guess I have a view, and which is, if you take a place like China, for example, that if you don't have a China presence and you're not paying attention to what's going on in China, it's going to be hard to be as successful and relevant in the United States or anywhere else in the world.
Are you talking companies or firms?
I'm talking if you don't participate as an investment firm in places like China. And an example, it used to be for many years that something would get invented in the United States. And so, whether it was eBay back in the day, and then people say, oh, we're the eBay of Germany, or we're the eBay of China. And that happened across industries, including places like Uber and other stuff. Things were incubated in the US and then copied around the world very quickly. What's happening increasingly is that there's companies being invented in many parts of the world, but China is the best example of this, where there's many companies that are very large, very successful companies, some that have 10, 20, $30 billion market caps in China. And the question is often, oh, what's the equivalent in the US? Who is that? So, an example is Meituan or companies like YY, if you're familiar with those. And people say, well, what's the Meituan of the United States? It doesn't exist. And I think if you don't,
Are you trying to find those or fund entrepreneurs?
We're looking for those, but I think whether you're an early stage investor or a late stage investor, I think if you haven't seen what's happening in China, you could meet a company in the United States and see what they're doing and say, oh, I'm not sure how successful, how large can this be, without knowing that actually there's a $30 billion company sitting in China. And two, what are the mistakes they made so you can give advice to the companies in the United States. So I think it used to be very much a west to east flow, and I think you're increasingly seeing an east to west flow, and I think the best investors are going to be paying attention to a lot of that flow.
Let's talk about the IPO market. Especially on the late stage, you guys are, presumably investing maybe the last money in before the IPO, and we've seen some pretty lousy performance from Snap and Blue Apron lately. Has that caused you to adjust your models for some of your other pre-IPO companies, David?
When we model businesses in the private context, we don't think about timing an IPO exit. It's always just kind of, doing our analysis over multiple years and thinking, yeah, an IPO could be an option for exit as well as many others. I think that's another surprising thing that's happened now is people would have thought the IPO market was going to be more robust.
There was a lot of optimism around that Snap IPO.
Yeah, a lot of optimism around it. And you've seen this kind of bifurcation, I think, in the public markets where you have people focused on just kind of fundamental long-term growth, ability with user trends, engagement trends, ability to monetize over a very long period of time. And then what you haven't really seen in the internet realm is more of a value orientation where, I'm always struck by, in things I look at in traditional media, so you have broadcasters and other traditional media that trade at certain multiples and that may have secular challenges coming and that you don't have, but people buy it on a cash yield. You don't have those public investors, value investors focused on this space just yet. But I think it's a matter of time before we get enough of those companies out there that are not the Facebooks, Googles, Apples, Amazons of the world.
So Amazon has been looming large over this entire conference. And so Kirsten, I want to ask you, have you considered investing your entire fund in Amazon and moving to Bermuda?
That's probably not allowed.
What are the opportunities that Amazon will not attack that you see as good investment opportunities for entrepreneurs?
Yeah. Well, listen, Amazon is an epic company. It's a formidable competitor across a lot of different industries. It was incredibly interesting to hear this morning about the way they approach business and tackle opportunities, and we pay a lot of attention to that. I think that something said was really interesting, which was we innovate for the consumer, and I think that that lens has so much opportunity behind it. The consumer, being the millennial or Gen Z coming up, has a really different orientation than all generations of past, and they have a different path to purchase. They have a different framework for making decisions, and it's upending so much and creating opportunity for different ways of engaging, for different services, for different brands. So I think that there are opportunities across the spectrum. I think that
any specific sectors or areas?
At the risk of this sounding like a milquetoasty answer, but this being an honest one, I think almost everyone. I think almost everyone. You take sector by sector, and you can have a conversation about how consumer preferences are almost demanding change. Everything from the food aisles, from businesses that have been around for 100 years, and brands that have lived through that time period that are now being kind of abandoned on the shelves of grocery stores for new upstart brands that are offering a different value proposition from the ingredient perspective or whatnot. And that's true kind of across the spectrum. This new consumer is asking for different things, and that's providing a ton of opportunity.
All right, I want to touch on Uber, because General Atlantic is an Uber investor. David, you just joined the board. When we spoke earlier, you mentioned that Uber has had a terrible year, but it hasn't hurt the business. But right now, the company has no leadership. Is it possible that you're maybe misunderstanding the latent effects of the problems the company's had?
Yeah, I wouldn't say it hasn't hurt the business. Obviously, reputationally, we've been in a tough spot, and I think if these issues aren't addressed, very serious ones, it risks actually impacting the financial performance of the company.
Aside from the
long-term
CEO,
value.
what's the most pressing thing that has to happen?
Well, look, I think there's a couple of things. We obviously have a series of leadership issues to fill, starting with a new CEO, and turning the page in terms of a very related point, the toxic culture that folks are aware of. These are serious issues. We as a board are totally focused on it because we have to be. It's not only right to change some of the things that have been experienced at the company, but it's also practical.
Do you think the company needs
People are proud of, want to go work at, people want to stay at, tell their parents that they work at, tell their friends. and we have a ways to go, but we're focused on it.
Do they need more house cleaning? Because it just was really crazy to me that 1,000 people wanted Travis to stay and signed this petition saying they liked the culture the way it was.
Yeah, I'm not sure. I wouldn't read into that as having liked the culture the way it was or is. I think it's more, Travis is a force of nature, and you have to give him a ton of credit for having built a business, at this scale, growing at the rate it is. I've personally never seen anything like this before. I think very few of us have. Now, naturally, with that type of growth, you're going to run into issues. We've run into a series of issues, and we need to address them now.
And one more question on Uber to both of you. Have you written down your stakes in the company?
Again, I don't think we disclose that publicly, but in our case, no.
David?
But we also don't write it up to, maybe just to give more, we don't necessarily mark it to where the latest rounds may have gotten done. We have a pretty conservative approach to where we value it.
Got it. David,
totally consistent with that.
Change. All right, and so I also want to ask, before we go to a couple quick audience questions, what are you doing with your other portfolio companies to prevent them from getting to this point? And I mean, have you changed your mind on certain things like super shares or voting rights, the kind of thing that maybe delayed the problem here?
Listen, I'll go first. I think that some of the issues that Uber has experienced, I think, are extreme, at least as it relates to our portfolio. And I think that even if you look at super voting, sometimes where founders have an outsized say, I think there are a number of founders and entrepreneurs that, in my opinion, have proven and deserve to have an outsized say. And I think some of the public companies that you've seen, like Google and Facebook, and there are others, have proven to be really good stewards of investors' capital, and that has been rewarded for other shareholders. And they want to be able to say, hey, I'm not going to have an activist shareholder come in and force me to not grow as fast or invest where I want to grow. And I think that that can be a very good thing. And I think there are a select number of entrepreneurs who've proven that. And so even in some of our private companies, we're open-minded to when CEOs say, hey, we'd like the idea over the long term of having control if they've proven they're great stewards of capital. And so I think we're open-minded to those situations. I don't think it's just the issues at Uber because a certain shareholder had more rights than other shareholders.
And advice for other VCs who are hoping to prevent these kinds of problems at portfolio companies? Any ideas?
Well, I would say that, kind of starting at the earliest stages, setting a culture is, if I look across our portfolio and see the companies that have accelerated growth, a lot of it is companies that were able to attract the right people, empower people in the right way, and drive a really good culture. And that started with the founders having a commitment to that, and that's something that we talked about really early. So baking it in as early as possible is incredibly important.
Can audience questions? Do we have anyone out there wanting to chime in? No, right here in the front. All right, here and then back there, and we'll be somewhat quick here.
Arthur Johnson with Twilio. Question for David regarding Uber and being on the board. What did the board learn about governance, and maybe detecting this sooner, that they took away as lessons, like key lessons learned in the Uber situation? And are you applying that to other portfolio companies and how you govern them from a board perspective?
Well, look, I just joined the board now maybe a few weeks, a month ago. I forget the time frame of it.
And I appreciate you taking all my questions on that.
Look, I think I sit across many boards now. I think each one of them you take lessons from. I think the Uber, what's going on there is somewhat kind of unconventional and extreme. And so we as a board have come together and coalesced around trying to fix these issues, whether it's implementation of the Holder report, changing, and it takes a while to change the culture of an organization, as we all know. And so it's not going to be a light switch that flips overnight. But I think, on the positive, when you look at a business like Uber, outside of the financial performance of the company, don't forget that over the past several years, the company's had the ability to hire the best and the brightest globally. And we have this latent talent base that is just looking for the right leadership, turning the page, and are incredibly motivated. And so I'm quite optimistic about the future. We're going to get through this. It's not going to be easy to get through it, but we're certainly focused on trying to.
Another question back there? Wait, was there not somebody? Okay, sorry. Another question? Anybody?
I maybe had one comment on something you said earlier while maybe other questions are being formed, is that I think the thing that's really impressive, unusually about Amazon, I was having this conversation, and there's a lot of things, but if you think about the last 30 years, there's been always a dominant tech player where people were worried about competition and them taking over the world, so to speak, and
Yeah.
front pages of
We all saw the
various
picture
magazines.
of Bezos with the muscles.
But I think what's interesting here, if you look whether it was Microsoft at a certain point in time, it was Google at other times, and then maybe Facebook and others. I think the thing about Amazon that maybe makes them A, more impressive, and B, maybe scarier than other companies is that they don't, the other companies really had to buy their way into new innovation. And so they had their initial platform, it was Microsoft with Windows and Office, or Google with Google Search, but most of those companies bought their way. So Google buying Android, or YouTube, and there's a big list of other companies, or what Facebook's done an amazing job buying Instagram and WhatsApp and other stuff. But the thing that's maybe most impressive with Amazon, and maybe most scariest, is that most of that innovation has come in-house. And so when they launched, whether it was AWS or Echo and tons of other products that people are aware of here, they've done it from scratch. And so they've got this culture and I think that makes them perhaps the most impressive of those, if you look at different decades, and it'll be really interesting to watch the next 10 or 20 years, because they've been growing, and now they're getting into M&A and other stuff, but really their innovation has come organically, which is...
Okay, so extra scared of Amazon. One more question up here in the front.
Hi, Caitlin Kyle, S&P Capital IQ. How many deals, especially at the early stage, are you looking at before you make an investment? And how are you sourcing those deals to find the early stage ones you like?
Yeah, we're looking at a lot of deals. So I would say, in any given month, it's a couple of hundred. And let's say we make 6 to 8 investments a year. So, part of hopefully trying to be good at this business is having a process around how you filter through that. And that's from, I think, coming proactively to the table with some thesis of different things you're looking for. So when you see something like that, you know to take it seriously and learn. Also being proactive with going out and kind of finding out who's doing something in those categories in that space. But there's, and that is a lot of deal flow, but there are a lot of firms getting that kind of deal flow. So back to a point I made earlier, which is this is a very active ecosystem. There is a lot of early company formation still happening. And at the same time, while there's been more dollars raised by venture capital firms, the number of firms has actually gone down. And so that money is being consolidated in fewer places, and it's actually, I think, contributing to making it a lot more competitive. It's a lot more competitive to get follow-on fundraising rounds done.
Thank you. And so we are exactly out of time. Guys, this was really great. Thanks a lot.
Thank you.